Get this show on the road. How's everybody doing this morning? Haven't seen you in a while. We took the week off last week. Why did we take the week off? Well, I think it's obvious. The whole country was in mourning, and my office was very much in mourning and very disappointed and saddened. And so I gave the whole office the whole week off. All right. I don't think that was such a bad thing. I felt a little guilty kind of sitting there chasing dollar bills when we had such a sad country, sad world, at the time. So I thought, us capitalist bastard money mongers don't need to be out here, chasing dollar bills when other people are, mourning the lives of their friends and colleagues and people who have had bad things happen to them, right? So it especially took a hard knock on Claire. So that was she's worked real hard though on Pit News Magazine. Pit News Magazine in October is going to be awesome. She does have a nice tribute to Charlie and Alina, so we'll be looking forward to that, sharing that with you guys. And so I'm glad to see you guys here. It's good to have you. It's good to be back. And we're here to chase dollar bills. So let's start chasing dollar bills again. All right. I've got a lot that I've done and worked on over the week, and so I'm excited to share it with you. Look at this market. Look at the S&P. I've never seen this. This is just unbelievable. All right. This is unreal. How many drives? And it's just going straight up. It's not. This is just blowing everything else out of the water I've ever seen. Drive one. That's kind of almost, I want to join those two together. We would just call that drive two. And then look at this, same thing here. We're in a big drive three right here. I know it looks like we got all these little breaks in here, and it screws you up, and you're like drive one, drive two, drive three. And we thought that at first. Hindsight's always 20/20. You can always look back at the market and see it more clearly. This kind of needs to be combined. This kind of is drive one, drive two, drive three. Does that mean it's going to tumble and fall up here? Who knows? And this market is just unbelievable. Now, one of the problems that we have is that let's go over and look at the news before I start talking about the problems that we have with this market. All right, they're the things that give us stress. The thing that's driving this market higher is primarily the top Big 10 companies. All right, basically the top Big 10. The rest of the market is acting pretty much normal. I mean, it's going through, if you go over and look at the individual stocks within the S&P 500, they're going through regular, accumulation, distribution, 3-drive patterns, ABC patterns, Fibonacci, everything. What's not is the Magnificent Seven, basically. The top Big 10 companies of the S&P are what's driving this thing higher. This is AI boom. That's what's driving this thing up like this. And it's crazy. We got a great article in Pit News Magazine about how they're going to, it's crazy. I got some inside knowledge and talked to Grant Thorne. Grant Thorne ran some deep background, and I think you're going to be surprised what you hear in Pit News Magazine this month. We got some real juicy information about how they're gonna electricity is a big deal for all these AI things, right? And all of you guys, I got so many things I want to say. My mind's going to go everywhere for a little while. AI. I worked on it all day yesterday for something for you guys because I wanted to have it ready for class today, and I'll show it to you. But it took me all day for the stupid AI. I've owned a computer programming company basically my whole life, my whole professional career. Worked for computer programming companies and started out as a computer programmer myself in high school, college, and then didn't really. I wasn't that great at it. All right, I was a programmer, but I wasn't one of the great programmers. I was better at design. I was more like why we program, not how we program. And so I was more the design engineer. I was like, we need to do this because I went and spent 10 years working primarily back in Chicago with the Chicago Board of Trade people, learning all about trading because I was so enamored with it. So we wrote the software, and that's how we came up with it. But I didn't write the code for the program. All right, I didn't write the code. I was the design engineer. I was the one saying, okay, this is what everything needs to do. Because you hire a bunch of programmers, they don't know the first thing about trading. They don't know the first thing about anything, right? They know how to write code. They learned that this colon goes after this semicolon and this comma goes after this, string of letters that makes this computer do things. That's what they know. All right. But they don't know the first thing about trading. They don't know first thing about the stock market. They don't know anything. So you have to sit there with them basically, and you have to say, okay, this is what we want the market, or this is what we want the software to do. And so you have to be the design engineer that sits there and tells the programmer what to do. Well, I've been doing that with AI, right? AI is going to take over the world and we're all going to die. Boy, let's not leave it to AI yet. I mean, holy smoke-a-roonies. Yesterday, I was sitting with AI doing my design engineering stuff, saying, this is what I want the software to do. And oh my goodness sakes. Oh my goodness sakes, is it dumb? It took me like 2 hours to get him to sort a column. Just click the header and make it sort down, click a header, make it sort the other direction. And then when we got it kind of working the way I wanted, I asked it to fix one more thing, just add this one little thing, and it screwed up everything we'd worked on all day. And I said, well, just go get the old version. Oh, I don't have the old version. We don't keep backups. It's like, well, I got the backup, so here's the old version. I give them the old version. They're like, oh, well, that's too bad. You got the old version. I can't fix that. It screwed up everything I tried to do for the whole day. Oh my goodness sakes. It's not ready for prime time, guys. It's not going to be taking over the world anytime soon. I promise you that. All right. It's really cool and I love it and it's great. But man, oh man, it might be smart, but it sure is dumb. It's not wise at all. It is smart, but it's not wise. All right. So yeah, this is the Trump bull train, Chad says. But mostly this is the AI. This is AI that's doing this. And of course, you can give Trump a lot of credit for that because he is behind the AI push really big. He's really supporting them a lot. And the electricity is the biggest problem, right? The electricity. And so that's just a little heads up of what you're going to see in Pitt News Magazine, this issue. There's an article on how they're going to get the electricity. It's eye-opening. It's going to blow your mind. All right. Okay, so that said, I wanted to come over and I wanted to look at the news before we got distracted here. All right, so I've got the news pulled up here if I can find it. Here it is right here. So this is the news. All right, what's going on today? And this is going to take us down another little rabbit hole I want to talk about for just a minute. I know Chad is big into currencies and he's big into the stable coins and that kind of thing. We're going to talk about that just a little bit for Chad here today. But as you can see, we're going to come in here and Fed Bowman's speaking. Well, he spoke already, 7 o'clock. Well, it's 7 o'clock my time right now. So he's speaking right now. Oh, no, wait a second. It's 8 o'clock my time. I think the battery died in my clock. It says it's exactly 7 o'clock on the wall. Yeah, that thing's wrong. My computer says 10 after 8. So he spoke an hour ago. S&P Global Composite PMI, so the Purchasing Managers Index. Forecast was 54, actual was 53.6. So they're buying a little more. The real more Purchasing Manager stuff, S&P Global Purchasing Manager Flash. This stuff is all pretty typical stuff. 2 impact. The 3 impact is this one here. Fed Chair Powell speaking today. Now, is he going to lower interest rates today? No. This is not what he's doing. And I pulled up a little article for us here. Just real quick, I'll read this for us. This is something I asked Grok. I actually use Grok a little bit more nowadays than ChatGPT. I like Grok. But yesterday when I was programming, I tried to program in Grok. Grok couldn't keep up with it's not like it's a real hard program. We're going to jump over and show you what we did yesterday because I did it for you guys. I want you to see what we did. So we're going to jump over and show you the program that I had, that I designed, but had Grok program. But Grok couldn't do it. So he completely failed on the programming front. So any of you who are afraid that Grok is going to take your programming job, not that we might be some programmers in here, but probably not going to happen anytime soon. All right, let's just say he's pretty cool, but he is not going to take over your programming anytime soon. Okay, so no, Jerome Powell is not expected to announce or implement an interest rate cut today. All right, so I asked, that was my question. Fed Chair Powell speaking today is expected to lower interest rates today. So the Federal Reserve Open Market Committee, FOMC, sets interest rates through scheduled meetings, with the most recent one conducted in September 17th through the 18th, where 2025, where the Fed already lowered the federal rates by 25 basis points to a target rate of 4.0, 4.25. Now, I know that Trump wants it to go lower. Too late, pal. Too late, pal. You hear him say that all the time. Powell's awful. He's trying to, he won't lower interest rates. Why does Trump want interest rates to go down? Well, he wants interest rates to go down because he's in the best interest of what he's trying to accomplish, which is lower taxes, which is nice, right? Lower debt for the country, which, as you all know, the debt now is so big that the interest is bigger than the national, than the U.S. military spending. The debt bigger, the interest on the debt is more money than what we spend on the entire U.S. military, which is like bigger than the next 7 countries combined. All right. So we got a big military. We all know that. We're kind of big military country, right? The world's policeman. And so the national debt, the interest is so big, it's bigger than the budget of the U.S. military. That's not good. And of course, his goal is to bring that down. He doesn't want that. And so if interest rates are up at 4.25, that's not good. He's paying a lot of interest. If we could get that down, that wouldn't be so much, and it'd be easier to, do some of the fiscal things that he wants to do. But you got to take that into consideration. We're not, I know. It's like somebody's got to pay for the debt. We keep kicking the can down the road and putting it onto our kids. But technically speaking, if we didn't have such a big, nasty debt that we weren't trying to pay off, we wouldn't want interest rates down at 0. We wouldn't want interest rates at 2%. That's not good. It's not good for the country to have interest rates that low, because 4% is low. That's pretty low. I know that the kids in the who are trying to buy homes and stuff are like, interest rates are so high. It's only because they've lived their whole lives with interest rates at 0. And interest rates at 0 can't last either. That's not realistic. And do I think interest rates could go lower? I like them at 4%. That's perfect. That's right where they need to be. Do we want to go below 4%? Well, then you start having people who live off their interest rates not have any income. So, whose problem are you trying to solve? Do you want your CDs in the bank to go down to 2%, 1%, 0%? A lot of people live off their interest rates. That's how they live. And you start knocking that down. Well, those people who, generally older people who are trying to live off those interest rates so that they can make ends meet, they have less and less money too in their hand, and it makes it difficult for them. And so what do? Well, they end up going on government assistance, or they're already on government assistance with the Social Security, which isn't really government assistance, but they treat it like it is. But the fixed incomes government assistance coming in, or Social Security coming in, and then you take their 4% return on their money and their savings that they're trying to live off of and drop that down to 3% or 2%. That's really painful. It's really hurtful to people who live off their interest rates. Now, you and I are looking at that and saying, we don't live off, who would ever live off their interest rates? We can just come to the stock market and earn more than that. No, a lot of people don't want to put their money in the stock market. It's scary. Remember, the stock market is a carnival game. There's a lot of people out there who are very risk averse, and they don't want their money in the stock market. That's scary. Scary place to put your money. All right. It's gambling to a lot of people. I don't think it's gambling. You've heard my story on that. I don't think it's gambling, but it is a carnival game for sure. All right. And so this 4% is right where we want it, in my opinion. And again, if they drop it, what's going to happen to the stock market? The stock market is going to go shooting straight up if they drop the interest rates. Well, the market's already shooting straight up. Usually when a market does this, they raise interest rates to try and slow the market down. So a big market like this is actually an argument for higher interest rates. We don't like to see markets do this. I mean, you and I do. Because we have a bunch of money in there and we like to say, oh, look at me, I'm so rich, I'm so smart, making lots of money. How smart were you right here? How smart were you right here? I was dumb. I'm so dumb. But over here, oh, we're so smart. Oh, look how smart we are. Oh, we're smart, smart, smart. Well, the bigger they are, the harder they fall. The bigger they are, the harder they fall. Is this thing going to crash like this next time? I don't know. I don't see any reason why it would, but I didn't see any reason why it would back there either. It just does. Markets have a tendency to flush. Doesn't mean it's going to. I mean, I thought it was going to flush right in here. I thought it was going to come up, test this high, break through it a little bit, maybe right here. And I thought we were going to tumble right here. And I think a lot of people did. That's why we kind of got this little thing in here happening. And then it just didn't. BlackRock and all those guys, they didn't jump on board. It all has to do with what the big boys want to do. And right now, the AI is just going nuts. Look at this thing. It's just crazy. Crazy. So we're going to come over and look at the SHI. I've got this pulled up for us. This is interest rates right here. This is the 1 to 3 year T-note. Interest rates go up, stock market goes down, right? That's what we generally say. Stock market goes down, interest rates go up. But look, interest rates are going up and the stock market is still going up. Remember, the Fed is like, they're like the stereo control. They're like the front of house guy when you go to a concert, or you go to a dance at the down at the the dance place, and the guy that's sitting there, the DJ, he turns knobs, right? He turns knobs to make the sound just the way he wants it. Sounds good if he turns this knob, sounds a little louder if he turns this knob, turns down the bass, turns up the treble. He has all the controls, right? He can sit there and maybe he's got sliders and he's sliding the sounds up and down. Well, that's what the Fed is. That's what the Fed is to the economy. The Fed has all these little sliders or little knobs, think about it however you want, and they move these little sliders and knobs, and one of the most important one is the volume, right? Volume, oh, that's the most important one. Well, that's what interest rates are. Interest rates to the Fed is like the volume. They can turn it up or turn it down, and they got all these little sliders that they can push around that makes the economy do what they want, right? Now, it's a slow reaction. They turn the volume up, and it takes a while for the volume to curl and come back down, and then they can turn the volume back up, and then it goes and curls and goes the other way, right? They can turn, but it's got lag in it. And so that's why Trump is always calling him too late. He turns the knob too late. He should have turned the knob earlier. He should have turned the knob the other way earlier. Should have turned the knob. He's always too late at turning the knob. It depends on your point of view. Right now, I don't think that we should have lower interest rates. I mean, this is lower. This is higher interest rates right here. This thing going up. Now, they said they lowered them by 0.25 basis points, which obviously wasn't enough. But this market's going up. This is higher interest rates, and look what the stock market's still doing. Stock market is still going up. This is scary. That's all I'm trying to make. This is scary. All right. This is scary times. It's scary. This is like a big, huge giant, right? And the bigger they are, the harder they fall. And we don't like big falls, but the bigger they are, the harder they fall. It doesn't have to fall. I mean, you could just keep going straight up forever. I mean, we got tariffs coming in. We got so many things happening. All right. So anyway, that's my little rant and rave there. And I always want to talk. And now I want to talk a little bit about two more things before we get looking at the portfolio. I want to talk about unemployment and the unemployment rate. Unemployment is below 5% right now. Now, remember, we always say that, we've always said my whole life, we don't say it anymore for some reason. I don't know why, but we've always said my whole life that anything below 5% is full employment. Anything below 5%. 5% unemployment is right where we want to be. All right. 5% is the magic number. Just like 4% is a perfect place for interest rates. All right. Again, I know that people who want to buy houses want to have, because they're used to zero. But my first house, I paid 12.5% interest rate on it and thought I had a great deal. Not that I think the problem is the houses were a lot less expensive, but so was my income. It's all kind of relative. I mean, I know houses are way more expensive than rates, and I don't want to be that guy that says, "Oh, buck it up and go buy a house." No, the houses are damn expensive. I know they are. They've outpaced income by a long ways, and I'm not trying to be that guy. But interest rates get too low, it messes up the market on the other side. It's one of those dials that you start pushing that thing around and pushing it into, if you max them, turn the volume full blast, what happens? People run away. You turn it down too low, people can't hear it. It's got to be just kind of right in there, just right center. If you can't put the volume to zero, and people are used to having interest rates at zero for so long that they don't know what it means to turn the volume up and have a little, listen to a little music. And the problem is, while the market they had it at zero, that screwed up everything else. It's because they put it at zero that the house rates went so high. Cost of housing went through the roof. Why? Because interest rates were at zero. You could borrow money for nothing. I mean, it's a cause and effect thing here, people. Remember, we're all armchair economists, and you can understand these things from both sides of the armchair. You got to think about it from both sides. Oh, we go to zero interest. Well, what's that going to do to the cost of everything? It's going to go through the roof. Why? Because money's free. That's what caused the housing price to go up in the first place. Well, I want zero interest so I can buy a house. Well, all that's going to do is drive the price of the house higher. You get zero interest rates, so the price of the house is going to go way higher. Price houses come down if they raise the interest rates. It's kind of like what we call, balancing things out. There's cause and effect to all this stuff. You don't get free anything. There's nothing free. You can't have zero interest rates and low prices of houses because it just doesn't work that way. Now we got interest. I want to talk I got all these things to just get off my chest with you guys. We've got unemployment. Let's talk about unemployment for just a minute. 5% was always considered full employment. I mean, full employment across the board. Now we're trying to get down to, unemployment's all the way up to 3%. Oh my gosh. Oh, you're a terrible president. Your policies are so awful. We got 3% unemployment. Oh my gosh, people. We've always considered 2.5% is people who are switching jobs, moving from this job to that job. And I know some people are like, you shouldn't quit your job before you have a new job. But a lot of people do. They get mad, they quit their job, and then they go look for a new job. But we always considered that was 2.5%. 2.5% are in between jobs. These are not people who don't want jobs. These are not people who can't get jobs. These are not people who don't, are not able to. These are people who are in flux between jobs. Highly, educated, good people, willing to go work. They want jobs. They're just in between. And that's okay. People switch jobs. That's what happens. So 2.5% is always just the people who are switching jobs. That leaves you 2.5%. That other 2.5% are people who either one, physically disabled, can't work. We have people who simply won't work. Now, this does not include the retired. This is the working class. All right. So you have 2.5 who are always between jobs. And then you have the group of people who just absolutely will not work. They refuse to work. Doesn't matter if they could get a job or not. They're just not going to work. There's that group. So you got that group. And then you have the disabled and unable to work group. All right. They're at the right age to work, but they're not able. They're mentally ill. They're hurt. They're broken somehow that they can't work. All right. So we have a 5%, take the 2.5% out, that are the group that are just in flux. And we have basically a 2.5% group that just simply won't work, can't work. So anything, you get down into the 3% unemployment, 4% unemployment, that means there's not enough jobs. All right. I mean, that means there's more jobs than not enough people. There's not enough people. We're down under 5% now. We're under 5% for unemployment. Now, unemployment had a big spike because, Trump went in, Biden went in, and Biden, when he was in office, what did they do to keep unemployment down? Well, they brought in millions of what do you want to call them? I don't care what you call them. Foreigners. Brought in millions of foreigners. All right. One way or the other, they brought in millions of foreigners to take a lot of jobs. All right. So there were a lot less jobs for Americans. Okay. And you're like, well, the foreigners were taking jobs Americans didn't want. That's not true. That's not true. That's a lie. That's a fallacy, and simply not true. What it does by bringing in foreign labor that is willing to work for less than Americans are willing to do the job for, which is subpar income, right? Is it drives the prices of those things down. Again, it's cause and effect. If you bring in people who are willing to work for $4 an hour, well, the price of that product should, in essence, go down, right? It's a competitive market. So there's that guy over there who's paying $7 an hour, and there's that guy over there who's paying $4 an hour. Well, the price of the guy that's got $4 an hour, he can lower his price, sell more than the guy that's paying $7 an hour, and get a bigger pot of market, right? Costs are less. We're always trying to reduce the costs. So these guys who are bringing in the foreigners and working them at $4 an hour, where that guy over there is paying them for $7 an hour, well, who's going to win the cost plus race, right? So you're saying, well, the guys that are, they're bringing in, who would do that work? Nobody would do that work. Nobody would go out there and do those jobs at those foreigners. Well, that's why we got to bring them in. That's simply not true. Americans do those jobs. If there were Americans to do them, we're under 5% unemployment right now. Don't have enough Americans, right? So, but the problem was Biden brought in all these people, and then they were taking all the jobs. The Americans were like, well, what are we going to do? So what did the government do? They started hiring like crazy. The government ballooned under Biden. I mean, it was like enormous. It was this like big monster fat pig. I mean, the government's always been a big fat pig, right? But under Biden, it became just ungodly big, just huge, because he would hire so many people to make the unemployment rate look good. Oh, look, we got low unemployment, and we got all these people coming in. We got low unemployment. You got low unemployment because you put all these people on government payroll. They're not doing anything. They're just on government payroll. So that would keep the unemployment down, and that was his argument. So Trump comes in and says, well, we're going to cut all these people. Oh, you can't cut us. You got to sue. So everybody's suing for their jobs. You can't cut all of us. We got rights to have these jobs. It's just ridiculous. It's all cause and effect. So you start running all the people out who are making $4 an hour. These people who were working in the government have to go work for jobs because they all got hired on these big, high-paying jobs. It's just caused so much problem. It's just nasty what's happening to everybody and everything, because it all gets this stupid political rhetoric that's trying to, it's all for power. It's also they can get reelected. So anyway, that's unemployment. So now we got this problem with unemployment where we're used to having people working in the country for $4 an hour. And so all of our products were low cost. Oh, what about inflation? Inflation was huge during Biden. That was a whole nother deal. All right. But that's the cause and effect, that you have cost versus expense. And now Trump is not hiring more people to go into the government. So the government is slowly going down, laying off people. People are not being brought back in, trying to cut people out. So those people are going out into the workforce. And you got all of the foreigners being taken out. So the jobs are all in a big mix right now. So it's going to be nasty, and it's going to be ugly for a little while as we try to get back to something considered some sort of a normalcy. Now, in the process of that happening, we got AI bubble going on, which is driving this thing to the moon, and it's just scaring the living bejesus out of me, because this thing eventually we're going to get a pullback. Where are we going to get that pullback? I don't know. I thought I did. I thought we'd get a 3-drive pattern. Is this the 3-drive pattern? I don't know. I don't think that the 3-drive pattern, the reason we get a 3-drive pattern is because the big quant systems, the big, BlackRock, Vanguard, and State Street are the ones who drive these markets through these 3-drive patterns. And if they're not playing the game with all these stocks right now, we're not going to get the pattern we want. We're not getting the pattern. Okay. Chad says he thinks Q4 is going to be violent. I think it's going to be interesting. Violent might be a good word for it. I don't know. I don't know what's going to happen. I thought that September was going to be a nasty month. I showed you the charts. September is traditionally a nasty month. That's why I decided to do my portfolio rebalancing in September, and we're going to go talk about that. I want to show you my portfolio rebalancing. It's not turning out the way I had hoped. The market's going up, which is great, but my rebalancing was in anticipation of a market going down. So, as much as I know about the markets, or as good as you think I am about the markets, I still make decisions that are not the best for my portfolio sometimes. So I'm going to show it to you here in a minute. I'll go over and show you my portfolio, but I want to talk about stable coins for Chad for here just a minute, because you're going to start hearing a lot more about stable coins. Stable coins are going to come front and center, and you're going to be encouraged to buy stable coins. All right. Stable coins are like cryptocurrency. Think of them like kryptonite. It kind of works, right? Kryptonite, cryptocurrency, kryptonite. And in my opinion, and it's just my opinion, all right? And my opinion changes all the time. So today, my opinion says stay away from stable coins. Do not invest in stable coins. Now, if you're a wild and crazy trader, and remember, in this class, we've defined trading, investing, scalping, day trading. We know the differences, all right? So when I say investing, I'm saying go in, putting your money in, letting it ride for the long haul. That's an investment, all right? Don't invest in stable coins. Don't invest today. I'm telling you, with my opinion, and I'll tell you, I'm not big into these currencies. I don't like them. All right. Bitcoin, I've been involved in since I was a little boy, since Bitcoin was $12. I was buying Bitcoins for less than $12. $12 is about where I bought most of my Bitcoin when I first got started. $12. That's how long I've been involved in Bitcoin. All right. Bought the servers, did the server farm, did the whole thing. All right. Spent it all buying Spent it all paying for my son's education. Had I not done that, I'd be rich. Wildest dreams. Who cares? Right. But anyway, nonetheless, I don't have a lot of experience with stable coins. I don't like them. All right. And why don't I like them? I don't like them because they're pegged to the US dollar. But that's what makes them wonderful. They're pegged to the US dollar. Okay. Why don't you have a whole bunch of dollars stuffed in your mattress then? Why is that not your primary investment? Why don't you love US dollars? Well, the whole world loves US dollars. Yeah, the whole world does, because there's nothing better for them. But what about you as an American citizen sitting here? Do you want US dollars? Why don't you put all your money in US dollars? Come on, somebody knows the answer. Somebody knows the answer. It's called inflation, right? Why don't you put your money in? Why don't you invest it in US dollars? Because US dollars is constantly being printed, right? We print US dollars like crazy. And what does that do? Whenever there's more money in circulation, it's called inflation. That's what drives the price of goods up, because there's more money available. And it's not that there's more money available, it's that they've devalued your money, right? That's how they pay the debt. They do it by devaluing the dollar. And so if you're taking your stable coins and you're saying, well, stable coins are tied to the US dollar, so buy a whole bunch of stable coins. All you're doing is buying an inflationary product, a product that is going to go down in value by the inflation rate of the US dollar, which we already know is at a horrible inflation rate. Inflation is what we're dealing with right now, 4%, right? What's inflation? The interest rates are 4%. Inflation, they're trying to get down below 2%. They always wanted it 2%, right? Why? Why do they want 2% inflation? That's just a 2% tax on the American people. Anybody who owns US dollars has a 2% tax on them. Why? So they can pay down the national debt. That's how they pay it down. With the 2% devaluation of the money that's how they pay the national debt. Okay, so inflation is the rat that eats your net worth. Someone who was a millionaire in 1935 and held it in gold is now worth $57.14 million. It's not that gold went up, it's that the US dollar went down. You're like, well, buy gold, buy gold, buy gold. Gold's going up. No, gold's not going up. Look at this. This is how much gold it took to buy the typical single-family home in 1935, approximately 4.75 ounces. This is how much gold it takes to buy the typical single-family home in 2024, approximately $400,000 or $4,700, what the house costs, 150 ounces. So let me read that again. This is how much gold it took to buy the typical single-family home in 1935, which cost approximately $4,000. It took 150 ounces to buy that. This is how much gold it takes to typical single-family home in 2024, which is about $400,000. Still takes the same amount of gold to buy the $400,000 house as it did the $4,700 house back in 1935. Why? Gold didn't go up in value. Gold is the exact same quantity, 150 ounces. The dollar went down in value. Why are you buying gold? It's not going to go up in value. It stays the same. Dollar goes down. Right? This is how much it's gone down since 1935. 1935 was $1 million. Now it's worth $57.14 million. That's how much inflation has destroyed the US dollar in this country. So we oftentimes will say, due to inflation, leverage your inflation to offset your mortgage. $1 million in 1935 is worth approximately $50,000 today due to inflation. So if we take a 2024 minus 1935 is 89 years. So we take $1 million minus $50,000 equals $950. Divide $950 by 89 years. That's $10,000 a year that they've devaluated your dollar. So your dollar devaluates, your $1 million devaluates by $10,000 every single year. So the example rate is if you buy any physical asset, investment, real estate, land, etc., inflation will pay approximately $10,000 a year towards your purchase history, historically speaking. That's if you buy $1 million, right? $1 million asset will depreciate by $10,000 every single year. So if you buy a $500,000 house, inflation is going to help you pay for that $5,000 every single year. Does that make sense? Inflation is not good. So now what are we going to do? We're going to start buying stable coins, which are tied to the US dollar, which deflates by $10,000, 10% every single year. So how are your stable coins going to be stable? Now that's just me, armchair analyst Land Turner, thinking, because I have all this, armchair knowledge. And it's not just armchair knowledge to me. I own real estate. I have a bunch of investments. I have a bunch of money. This is something we fight with all the time, right? If you have money, you got to think about this. And that's what this class is all about. It's getting you some money. So if you're going to have some money, we got to start thinking about inflation, deflation. We got to start thinking about unemployment rates. What's going to drive products that we want to buy and invest in up? What's going to drive them down? What's going to pay off the national debt so we're living in a country that's stable, that we can invest in, have things, right? You're like, man, this is a trading class. How come you're talking about all this stuff? This is trading. This is investing. This is what investing is. Understanding all of these things are going to take and eat your money. That's why I got this big, ugly, nasty rat in here as the picture. All right. This is trading. This is investing. Understanding these things is really super important, especially when you start getting, $1 million, which isn't very much money when it comes to the investing world. $1 million is kind of like, well, I'm kind of a beginner. So when you're starting talking about a $10,000 loss every single year against your $1 million investment, you got it stuffed in a mattress under your bed, you're losing $10,000 just to inflation every year. So you got to make $10,000 on your $1 million investment every year just to break even. So where are you going to put it? That's 10%. No, that's 1%. $10,000, 1% of $1 million, right? So you got to make 1% just to break even. I don't know. It's all a carnival game. I tell you, it's a carnival game. There's nothing straightforward and easy. Everything's got dials and sliders to manipulate this whole world. All right, let's come over and look at the markets a little bit closer. Again, we got interest rates already going up, and the stock market is still going up. Interest rates are supposed to make slow the stock market down. So if they keep dropping interest rates, the stock market's just going to keep going up. And everything's going to get more expensive. Lower interest rates so you can buy a new house. Your house is just going to go up by probably the same amount of money as the interest rate goes down. So that's why, everybody was like, "Oh, Lan, why are you investing in real estate? Why'd you go buy that fourplex?" Well, I bought it because interest rates are so high. Yeah, but I was able to knock the guy down on the value of the price of the building because interest rates were so high. That was the argument I used. I walked in, I said, in negotiations, I can't pay what you're asking. Look at interest rates. Interest rates are so high. I got to have a lower rate. And he's like, "Oh, you're right. I'll lower the rate." I can't afford this building. Lower your rate. I got to pay this high interest rate. I can get a better price. That's the way it works. If interest rates were at zero, there's no reason for him to lower the rate. It's all a balancing game. It's all sliders and dials, man. It's all sliders and dials. All right, let's go over and show you what I was working on real quick so you guys can, let's pull up our other. Anybody have any questions? I know I'm going kind of over here and over there and over everywhere. Let's go look at our dream portfolio. This is the Richie Rich Fund. Let's see. So this is our dream portfolio. Why do you call it your dream portfolio, Lan? Well, because I got more tools. I got more sliders. I got more dials. All right. When we first started investing in these yield max funds and and we're going to circle back around to our UBI, Universal Basic Income Portfolio. It's what we're going to focus a little bit on here today. All right, tomorrow we'll focus on trading. We'll go and we'll do some day trading and we'll trade. But today we're going to focus on investing. So today is our Universal Basic Income Portfolio. So we want to look at that. And this is some of the markets that I'm a little bit more excited about. You can see them here on the right-hand side. Yeah, I'll get out of the way. I don't think there. Oh, there is. So here I'm going to move over here. How do I move over there? There we go. All right, so that's the list. So you can get your little cameras out if you want to. Everybody's got one of these little things probably attached to your hip somewhere. Take your little camera and snap a photo of that list right there so you can put it into your computer. Now, the reason this is my new list is because I want to look at, remember when we first started this, how would we do this? We would come over to this little program here, if I can find it. Right here, this little program right here, and we'd say, "Oh, I want to look up Tesly, TSLY. This is the fund that trades options on Tesla, and we like trading options because we collect the premium, right?" So we would come down here. Well, what's the premium we've been receiving? Oh, 39 cents for every dollar here, 30 cents for every share, not dollar. Sorry, that's very important. Share, because it doesn't matter how much you paid for the shares. They pay you your dividends, your returns. We don't even like to call them dividends in these markets. These are distributions. The distributions are paid on the number of shares you have, not how much you paid for the shares. Now, doesn't mean we don't want to get our shares at the lowest price we possibly can and dollar cost average into them and get us a lower share price. We do. But you look at this market, you're like, why in the hell would you ever invest in this market? What a shitty market. Oh my gosh, it just goes sideways all day long. No. You got to shift your mind. That's the whole idea of coming to this class is I'm going to take your mind. I want to shift it. There's two ways you have to think. When you start thinking about these yield max funds, which are new, they've only been around for about 2 years, right? And some of them have only been around a couple months. They keep coming out with new ones. So the oldest ones are only 2 years old. And you don't really want your shares to go up. You don't want them to go down. Obviously, we don't want to have a big flush in the market like this. This was the big drop in the market that we recovered from. This is the recovery. You're like, Lan, who wants that? That's not a recovery. That's a terrible thing. Oh my gosh, that's a horrible recovery. No, that's a great recovery. Okay. That means the market, our net asset value of our underlying of our account didn't go down at all. We made all that money and they gave it to us. It comes out and goes into our pocket, and we get to go spend it, buy new Teslas, right? So the idea here is that if this fund goes up, well, then you have to pay more money for your shares to get these same dividends. So if this dividend is 39 cents and you paid $9 for it, well, that's good. But if you get 39 cents and you had to pay $14 for it, well, that's not so good. Because you're not living off the growth of the stock. You're living off the dividends. All right. So this is an income strategy. It's not a growth strategy. Could you have made more money if you'd have been in the growth side? Yeah, you could have last year. Market went straight up. We just looked at the charts. All the stocks, they went straight up. Tesla went up. Well, Tesla didn't do as well as some of the others, but some of them went up as much as 300-400% increase. I mean, Palantir went up like 400%. So let's go look at Palantir. PLTY. This is the Palantir options version, but it didn't go up 400%. It just went flat. That's because they take the profits. They take the profits out. Every single time they make a payment, they take the profits out. If you keep taking profits out, you're not going to go up. Well, I want my stock to go up. Okay, well, then don't invest in something that takes the profits out. But eventually, you got to take the profits out, or else what's the point of owning it? If you own PLTR, and the market went straight up, you made all that money. What are you going to do with it? Wait for the market to turn around and go back down, you lose it all? That's what most people do. You got to, at some point, sell your shares, get out, take the profit. Realize the gains. If you don't realize the gains, what's the point of having a big account? You got to realize the gains. But Lan, when do I take the money out? And if I take it out, then I don't have any shares, and I run out of money, and I don't have any money left. That's the big dilemma, right? That is solved by this account over here, PLTY. They take the money out, give it to you, but you don't ever depreciate your shares. You still have the same number of shares, yet they're giving you all the money. It's the coolest thing that ever happens in sliced bread. Not sliced bread. I'm sick and tired of sliced bread. What's cooler than sliced bread? Nothing. Nothing is cooler than sliced bread except for these funds. All right? They're cooler than sliced bread. All right. These are cool funds. All right. They're really neat. Now I'm going to take you over. And we'd always come over and we look at these funds. We say, this is how much money we make. $2.41 in Palantir per share. Yeah, but shares are a little bit higher. $65, not like Tesla, down around $18, right? So $65, but you get $2.41 for every share you make. Now you can do the math. I'm not going to do it for you right now because I'm going to go do it for you over here in a little calculator. We used to do it manually, right? We'd come in and we'd say, okay, I got $10,000 and I got 64 shares per share. It's 10,000 divided by 64. And then I got how many shares I've got multiplied by the number I get, $2.41 per share. I could take that, divide it by the number. It'd give me the percent. I'd end up with like 90% annualized returns. Without depreciating any of my shares. I still get my shares. They just give me it. How do they do that? Without selling shares. Because they don't make their money on the growth of the stock. They make their money by selling options against the stock. All right? So that's how they make money. Now, what we need to do is we need to see both those numbers. Now, in the past, right, in this class, we would come in and that's how we determine which stocks we wanted to own. Now, we would do something else because I would always say, don't trade, don't enter your positions based on PLTY. This is just a holding fund of your cash. This is not an investment fund. Yes, this is where you put your money, but you make your decisions for putting your money PLT into PLTR, right? So we would look at this fund and we would actually trade this fund. I mean, make our trading decisions on whether we want to buy or sell this fund. We would buy or sell based on whether how much money we're going to put in the other fund, right? So look at this. This was where we were looking at the possibility of this market flushing one more time. We thought we might get an ABC pattern out of here, but we didn't. This market just way too strong. I added some in here, but I was anticipating another fall, and it didn't happen. Could it still fall? We were looking for the X2SA1 down here. It didn't ever happen. The markets are just unbelievable. Just like, how is this happening? How is this real? Right? How is this real? Is it going to flush right here? We don't know. Nobody knows. Is it going to keep going straight up? That's why we never go all in, we never go all out, right? Now I did, as I say that, I did go all out right here. I did go all out right here. I took everything off the table right there. And as it came down here and started going through this sideways trend, I was thinking, well, I can't draw on this stupid chart. Why in the hell am I even over here? Let's go look at PLTR over here, where we belong. PLTR, all right? So I was looking for this market to come up, make a little break here, and I thought right there we'd see it come back down and do one more down here. But it's going back up again. Now, is it going to test this high? And is it going to come down here? Or is it going to go up, test the high, give us a little one bar thing, and then go one more time? We don't know. But those are the patterns that markets have had a tendency to do in the past. The past performance is not necessarily indicative of future results, but it's the best we got. All right. So I looked at this and said, okay, this is what I'm going to expect to see here. I thought we'd get a repeat of that, and we didn't. We didn't get that repeat. So am I fully loaded on this one? I did put a bunch of money back in on my rebalance, because this down here was saying, well, land, don't fully believe that this thing's going to completely flush. This is telling us the big boys are buying. So I went and looked, and sure enough, of course, we don't know what the big boys are doing right now, because they don't have to tell us. They only have to tell us quarterly. So we can only know what they do last quarter. And so, you have to take that with a grain of salt, which is why you kind of have to reverse engineer what they're doing. Are they driving these markets higher? They are. BlackRock is buying. They're not doing any distributions. There's a few that they are. So there's a few markets that they're going right through this perfect 3-drive patterns and everything. I mean, here's your nice little 3-drive pattern. Drive 1. Look at it, how ugly it got. Drive 2, drive 3. And that was our break. That's why I thought that we were taking off right there. But then it's going right back up. I don't know. Is it going to do this? I don't know. Is it going to do one of these? Probably. I don't know. Nobody knows. But you're going to dollar cost average in as this occurs. So we watch these markets to invest in the underlying market. So this is where we put our money, but we do that for this market here. Now, the problem is we've been doing this manually, right? We've been doing this manually, and manually, nothing wrong with this. This is a good strategy. It's been working for us. We made a lot of money last year on this. Made, almost 100%, not quite, on our money last year. And we're just getting started, because we're just learning about these funds, because they're brand new, right? They're brand new. So this year, I think in 2025, 2026, I think is going to be a banner year for us. Why? Because we're going to have better tools. So here's the better tool. Now, I'm going to take you over into, I want to show you, if I can find it. I want to show you portfolio matrix. Now, this is my portfolio. This is my UBI portfolio. And you can see right in here that this is where we went through this big, huge tumble in the market. And during that big, huge tumble in the market, this is where everybody was jumping out of windows, right? Everybody's losing money, hand over fist. But this is what my market did. Did I lose money? Yeah, I did a little bit, but not like that. Why? Because my dividends, or my distributions, my options that were being sold, was helping me cover the losses as the market went down. All right. So the market went down really nasty here, but this is my account. This is what happened over here. So this was the growth. Growth went down. Equity stayed not so bad. And then the recovery, this was my growth right here, not so good, but look at the growth on the other. Now this is, see all this stuff here? Now this is where I think I made a mistake, and the reason you're here is to learn from my mistakes, right? You're here to learn from my mistakes. So my mistake was doing the rebalance of my portfolio the way I did it. I don't think I would recommend doing it. I'm not going to do it like this ever again. Okay. It was too much to do all at once. And so what I did is I got new information, and I decided that the funds that I was in were not the best funds to be in. I could have made more money doing something else. You know, you always look at hindsight and say, well, I could have made more money if I'd have done something else. Not that I'd be in something different market, but have different amounts in different markets and, you know, not roll in and out of some of these markets. This is what's happened during my rebalance. I tried to rebalance my entire portfolio through the month of September. And I'm not done. I still got more to go. So my September rebalance was a mistake. Don't rebalance your entire portfolio from all the things all at once, all in the same time. Look what it does to you. All right. And so if we slide down here to my income, you can see that in February I was made 26,000. March I made 27,000. April you made 30,000. Now these should be increasing as we go because I got more money to reinvest to get more free money on free money, right? That's the exponential compounded returns that we're looking for. So I started my account with about 400 and something thousand, and it's now up to 700 and something thousand, right? 750,000, something like that. So each one of these months, they should increase. Now they are 26,000, 27, 30, 53. Now we went down to 31, 30, 42. This was just a banner month. This May was just like unbelievable. We just got all these big dividends. So that was kind of an outlier. But then we got 31, and then we went to 30, and then 42. Now look, this month, this is the one that I've rebalanced. It's only 25. Now I still got some to go. There's still, we've still got a week to go, and I've got some big payments coming in. So it'll probably be close to, we're estimating close to 30, 32, something like that. I'll probably get about 10,000 more, 35. So it's still going to be better than July, which was the worst month I ever had, right? And then August was a banner month of 42,000, almost, not as good as 53, but it's 42,000, a lot of money. But now I'm going to cut that by probably 10 grand because of my this rebalancing the way I did it. I'm going to lose. I'm not going to lose it. I'm just not going to make it. I could have probably made, closer to 40,000, and I'm going to probably be closer to 30, 35, maybe 40. Maybe $5,000, $6,000, $7,000 is what it cost me to do this rebalance. Now, is it going to work out so that I make more money going forward? I think so. But here's the situation. I got more information in this little tool here. This is called Portfolio Matrix. So if you come in here and you type in a symbol, let's just stick with the ones we've been working with, the TSLA. So this is Tesla. All right. So Tesla doesn't have dividends. Come on, pull it up. Pull up Tesla. Why is it not pulling up my Tesla? TSLA. There it is. Okay, so there's Tesla. I'd hit enter. So this is just Tesla. This is just the value of Tesla. Tesla doesn't give dividends. So there is no dripping. There is no grow. There's no yield. All right. See, the yield over here is 0. So when I got this new tool, it got me thinking. I'm like, wow, I've been doing all this stuff manually, and now we've got a tool that'll actually show this to us. This is Tesla. So if we come in here and we go TSLY, right? So we got TSLY. It has both your gain, which in this case, Tesla had a negative 34% gain. So its NAV went down. So if you're out there on the internet and everybody's like, oh, I'm not trading those pieces of shit. That yield max stuff, oh, that's bad stuff. Oh, that's awful. Why? Well, its NAV goes down. The NAV doesn't go up. I want NAV to go up. Well, if you want NAV to go up, buy TSLA. NAV went up on TSLA. Had big NAV, right? So go look TSLA. So if you want big NAV, net asset value, TSLA, come on. TSLA, you had 70% growth last year. That's pretty good, 70%. If you'd have put your money in Tesla last year, even through this big rally and this big drop, from this point to that point, that was 70% return. So if you want to make big NAV, that's how you trade. And people out on the internet, you go out and look at all these guys. That's what they're doing. Oh, yeah, I can't trade those lousy yield max funds. They have lousy NAV. Yes, they have lousy NAV. Yes, they have lousy NAV. But it's on purpose Because if you have high NAV on these funds, you have to pay more money for the shares that you're buying that lessens your yield. And we're all about yield. All right. We want yield, not NAV, not gain. Okay. There's two ways a stock makes money: gain and yield. So if our gain is 0 and we have huge yield, that's great. Well, it's just the opposite of TSLA. 0 yield, huge gain. Which would you prefer? You can have one or the other. All right. Of course, gain can be negative. Market flushes, you can have negative gain. Yield is usually going to be a positive number, even if you have such a big yield, such a nasty gain that it's lower than your yield. That happens all the time in the stock market with something like, let's say, AT&T or Verizon, right? So if you pull up AT&T, let's pull up T. So AT&T, you got gain of 33% and a yield of 4%. Well, that's a banner year for AT&T, one of the largest stocks yields that you can get. 4%. That's banner. That's good. 4% yield in a stock. That's good. And your gain was 33% for a 38% return this year. That's what a lot of people who trade dividends are into. They're like, oh, I love my dividends. Got me 4.69% return. Can't get that down at Cash Valley Bank. Right? And the gain was 33%. But what if the market went down? Well, you could have lower gains and your yield would be 4%. The yield's going to stay roughly the same because they're going to give you your dividends at roughly the same rate, whether the market goes up or down. That's why they give you the yield. They try to encourage you to keep their stock. They don't want you to sell the stock. So they give you this yield, or they give you the dividends. Oh, it's got high dividends. Well, why do they have high dividends? Because they don't want you to sell their stock. So they give you high dividends. The gain is oftentimes not very good with the stocks that have high dividends. That's the reason they give you high dividends, so you don't sell the stock when the market goes down. But AT&T had a banner month last year, or a banner year. 33% rise. That's pretty good gain. That's not bad. But considering that the rest of the market went up like 400%, that's pretty shitty. But you did get your 4% return. All right. So that's how this new little tool works. It's like amazing. It's really cool. Okay. So we got this new information. We can come in, we can look at all these stocks. Oh man, this is great. JEPQ. Let's go look at JEPQ or JEPI. Either one of those. Let's at Q. Look at this. The gain was 4%. The gain on JEPQ, one of the very best ETFs that's ever been out there, they say. Right? This is one we used to invest in before all these yield max funds came out. This was like the top of the dog. Top dog. You go over to some of these funds, some of these groups. JEPI and JEPQ, that's their number one. They're right on top of the list. If you ever took my class down at university before we started talking about these yield max funds, this was one of the stocks I would teach you to get into. Oh, JEPI, JEPQ, great stocks. Why? Oh, they have great yield. 11.25% yield. That's killer. Way better than AT&T, right? That's because they trade options. Look at the gain, 4.81%. But that's because they have to take this big drop into consideration. If we just went back 6 months, let's just go back 6 months. Look at that. 10% gain with a 5% yield. That's 16% return on JEPQ. 16% return. If you remember, back in the day, 2 years ago, if you got 16% return on your money, you were just like high on the hog. You were running around the street going, I'm rich, rich, rich beyond my wildest dreams. Right? You remember those days? 16% return? Holy cow, you get 16% return. All you need is $2 million. You could retire if you had $2 million. That was what we tell everybody. Your goal to retire is $2 million. You got to have $2 million, and then you get 16% return. You have $160,000 a year. Ooh. That's great. And then somebody came along called Yield Max, right? And he said, well, what if we did something like this? And he started off with something called, I think one of his first ones was Tesla, TSLY. And he goes, I'll bet I can beat that. And so his gain, in this case, down 34%. Well, that's because we had this big flush, right? So we start out here, we went up and then flushed like a toilet. That was the big bad daddy, right? Big drop. And then the market went sideways in Tesla for a long time. So we had a negative 34% return. Anybody who got a negative 34% return would think that was just terrible. I lost 34% in the market. Oh my gosh, I'm dead. Oh, why did I invest in that rotten market? I lost 34%. Oh my God, I'm dead. I lost 34% of my market. But they gave you a yield of 83%. A yield of 83%. What was AT&T giving you? 4%. What did JetQ give you? 4%. These guys gave you a yield of 83%. And you're whining about a 34% gain. Now, yeah, I am. I still got 48% return on my money when I lost 34% on the NAV. I still got 48% return because the yield was at 83%. Yeah, but you had NAV decay. Okay, I don't really care. I don't care about a 34% NAV decay if they're going to give me 83% yield. Why the hell would I care about a 34% NAV decay if they're going to give me a yield of 83%? I still made 48% return and the market sucked. See what this new little tool gives us? This little tool does all the nasty work that we were doing before by hand with the little calculator. Okay, I got $10,000. Okay, they give me and we couldn't see the exact numbers. We could only see the one number we were dealing with, and that's why we were dealing with that. That's how we were doing it, right? All by manual. So my son and I said, let's create a calculator. Let's create a tool that'll do all this for us. And all we have to do is just type in the symbol, and it'll tell us all those calculations we were doing by hand. Come in here. Put anything in here you want. Doesn't have to be a yield max fund. TSYY. This is Granite shares, right? So this is your Granite shares. Now, here's Granite shares. Now, we had some of this, right? We went, oh, look at this. Great. It's got a great yield. But the gain on it, the gain on it was negative 65. Now this is new, and this is the thing about this fund. Anytime these funds come out brand new, now there are exceptions. There's a few of them that'll go up right out of the gate, but most of them flush like toilets. Almost every single one of them. They overvalue them on the initial IPO, the initial release. On almost every single one of them, I've seen 2 or 3 where they actually went up. Not rare. So, but then they get their footing. They kind of go down, and then they're like, okay, things are not so bad. We figured this thing out. We know where our balances are, and things start to level off. But look at the yield on this thing, 95%. 95%. So in the old way, we'd come over here and we'd say, okay, DSLY, right? And we'd come in here and we'd get our little calculator out and say, I got $10,000 and I got it by 8, divide by 8.45, and I'm going to look at this, and this can be 22 cents. So I look at, oh my gosh. Oh my gosh. They're giving me 85% return. How can I trade against that? I got an 85% return, right? 95% return. And that was the only number we were looking at. We could look at, right? We could come over to track and trade, and we could pull it up. But the problem is we didn't have a lot of history. So we come in here, we go TSYY, and we do our Fibonacci numbers. You can't do a Fibonacci number on that. You're like looking at that going, oh man, that's called NAV decay. If you want to talk about NAV decay, that's NAV decay. Whew, that's painful. So you're like, well, it looks like it's not NAV decaying nearly as badly right now. So you kind of eyeball it, right? Spitball. Yeah, this is spitball trading. Well, we don't have to spitball trade anymore. That's the point I'm trying to make. We've moved up into new technology. Now we can see what the spitball was. Gain was 65% NAV decay. Oh my gosh. Now you're talking about NAV decay. Now the boys over on YouTube are saying they have NAV decay. Yeah, that's NAV decay, TSYY. But they had yield of 95%. It still gave you a gain of 30%, which is still more than you could get out of JEPQ or JEPE or JEPI. JEPQ, JEPQ, JEPI. There's two of them. JEPI is out of trades the S&P. JEPQ trades the QQQ. Thus JEPQ. Get it? SPI is for the S&P 500. But look, even with this shitty TSYY, you got 30%. Now, is TSYY shitty now? No. I mean, that's 1 year starting back from the IPO. If you go to 6 months where it started to level off, look at this baby. Now you got 38% in this one, and it's at 40%, which is 40% starting to become acceptable. 40% return. That's good. That's good money. And that's over even the last 6 months. If we go 3 months, you got, well, 3 months, we haven't got anywhere down. 20 on the gain, 34 on the yield. It's only 14% over the last 3 months. So there's things that are better that we can work on. So we were thinking, hey, this thing has 95% yield. We're going to throw a whole bunch of money in there. And you come to find out it's not as good as we thought it was. All right. There's things that are better. So we can roll our money into others. So now Land Turner, this smart guy that I am, I start thinking, hey, I've got a list over here on my little Pit News Magazine, and I've developed, right, this little dividend calculator. So I told you I did this for you. So this is the dividend calculator I worked on all day yesterday. Actually, the day before too. I worked on it a little bit on Sunday, a little bit on Saturday, a little bit on Friday, and all day yesterday trying to get this thing updated. Oh my gosh. I'm telling you, AI is not as good as you think it is. All right, as they want you to believe it. It's cool. I don't want to, but when it comes to programming, it's not going to take anybody's programming jobs anytime soon. All right. It's still got a ways to go. Let's just say. All right. So we're going to come in here. How much income can I earn? I'm going to put in here $10,000. All right. I'm going to hit calculate. And we're all familiar with this little table, right? I've showed you this a million times. But I added these tables that we got from over here, this thing here. All right. All in one. So now we can come over here. And in here, you can see I've got the symbol, I got the underlying, I've got the yield, 140%, 6-month gain. This is over the past 6 months. All right. I didn't want to go back a full year because of that big nasty drop. I want to see what it's doing in the last 6 months, not counting that big nasty drop. All right. Now, the problem is this big front has that big nasty climb. So we have to take it all into consideration. Markets are just nuts right now. Okay. So can we anticipate the market, the gain is going to go that much? Not necessarily. Okay. So this is TSYY, and that's the one we were just looking at. We have a yield of 140%. Unbelievable. Wow. We want all in on that one. But then you look at the 6-month gain, which is negative 44%. The yield plus the gain, though, when you take the 140 and the 6-month gain of negative 44, you still have a 96% gain. And you're like, Land, we'll sort by that one. Just give us the yield plus gain. Click on the header and sort that. I had that yesterday. And Grok lost it. Not Grok, ChatGPT lost it. I had sorting on yield plus gain. You could sort, click that header, and it would give you all the high ones at the top. I had it. And then I asked it to do one more thing. I said, let's see this little underlying, the results is your little help screen here that tells you what all these things are here. I said, can you update this right here? Go in there and just say, tell us what all these headers are for, and just give a little help. And when it came back, it lost all the work that we had done for the last 2 hours of sorting and all that. Oh my gosh. And I said, you just screwed up all the work we've done the last 2 hours. Can you go back to the backup? And it's like, no, I can't. We have to rebuild it again. And I was just like, I lost my patience. I can't deal with this junior programmer. This junior level programmer. So I have the update. I have a version that will sort that header right there, but it goes so slow. This was a lot faster to load. When you hit that sort, for some reason, it was so slow. You had to wait and wait and wait and wait and wait and wait for it to form. It's like, yeah, but I'd rather wait a few minutes to get the sort. I know. I'll work on it some more. I promise. I'll work on it some more because I want the sort too. So anyway, you see TSYY, that's sorting by the yield right now. So the high yields, and then the gain is negative 44, giving the yield plus the gain is at 96%. That's still pretty good money. All right. Now, when we come over to here, we get a little bit different reading because we're starting from different points in the trend. You got to realize your numbers are coming from different starting points. All right. So this is you're going to want to go with this one. This one's more accurate, 100% more accurate than this. But this gives you a good idea of where to start. So what we've done is I've gone down. Now I've done this with a calculator. It's all manual. All I have to do is sort it. I can grab the top 10 and there's my portfolio. Right. And this will change, of course, as we go through. And I got a little program that updates it. That's another thing we programmed yesterday. I click a little button and it'll go out and it'll update all this stuff once a month. So that's pretty cool too. So now we got this. I'm pretty sure that makes you smarter than Grok. I don't know. Grok's pretty smart. But he's not very wise. That's the problem with these. They're smart, but they're not wise. All right. They don't know why they're doing what they're doing. You tell them to do something, they'll do it, but they have no clue why they're doing anything they're doing. They have no clue why they're doing anything. All right. So I went through, and again, I showed you this last week, and this was my manual version that I did, if you can see it. And this was the ones I chose. I manually went through this whole thing and calculated all these things by hand. Well, actually, I did it with Portfolio Matrix, and I wrote down all the ones. So I went down through all this whole list, pulled them all up in Portfolio Matrix, calculated them all out, put them all into a list, and these are the ones that came out to be the very best ones to be a part of. And that's why I'm doing a total rebalance of my portfolio. So full circle, all this stuff that's going on. So this is available to you. You go to pitnews.com/dividend calculator, and you have this list. This little calculator is available to, it's just out on the internet. There's no link to it. You can't go search for it on Google. You can't find it. It's not there. The only way you can get to it is if you know about it. All right. So you guys know about it. So you have to come to this class to learn about it. And so it's pitnews.com/dividend-calculator. You can see it right up there on the list right here. See? There's your URL right there. Hopefully you guys can read that. You don't need all this. This is all the stuff that tells it what to do. All you need is this part right here. Right there. That's all you need. All right. And I just give you this for free. So pitnews.com dividend calculator. Can you see that? Write that down. Take a picture with your camera. If it's too small, you can't see it. Take a picture with your camera and blow it up with your fingers. Do that little pinchy thing. And then you can come and play with this a little bit. All right. And it's got other calculators in here. This is our break-even calculator. And that all stuff still works. Grok broke it, but then I had to tell him to go back and fix it, and he did. And then the dividend calculator. Of course, these are, put in your dividends like we were doing the old manual style. So this all stuff is here available to you. And of course, we got this one here. You come in here. If I, how much do I need to invest if I want to make, let's say, $100,000? Let's say I want to make $100,000 a year. You need to invest right here. Investment 8,000 would give you that with TSYY, 10,000 with NVDY, 11,000 with MRNY, 11,000 with NVYY would give you. Looks like we got some investment would be 8. This says 8 million. If I put $1 million in, that's not what I'm desired. I think I got a bug in here. I think we're still got some work to do. Anyway, that's the point of having this one, so that we don't have to do this one. But the most important one is just this one here, 10,000. This is the little list that this thing's pretty much going to sleep. There's no reason to actually have this anymore because we have this. All right. But I was showing you, this is how I came up with that list. So we have that list, yield plus gain. I think we got some bugs in. I don't know. I'm going to have to look a little bit closer at it. But this is the yield plus gain. And that's what I did all manually. But now we came over, and now that's what's over here. And that's why I told you to take a picture of this earlier. So this list that was here, right? This list here This is now here. So you don't need me to give you this to take a picture of this, because you got it here. This is what this is. All right. Now I got a couple of, like hood, I got the stock in there, but that's okay. You have to look at both, right? So this is and look how long it's only been going for 1, 2, 3, 4, 5 months. HOOY, 5 months. So you look at this one, you go, wow, look at this going straight up. Yeah, do you want to buy into that? I don't know. I don't want to buy it. Ooh, that's going really high, because if it flushes like a toilet, well, your NAV's going to go way down. Well, how badly? Well, I don't know. Let's go make some educated guesses. We can come over here, go back over to Portfolio Matrix and put in hood, HOOD. Now we can see that the gain over the last 1 year was negative 65. It went down. But the yield was 95 for a return of 30.35%. But that's from the beginning. Remember, every time they do that, that's a nasty thing. So we come here, we're at 40%, which is respectable. If you look at our little list, 40% is good money. You can make a lot of money with 40%. Okay. So some of the best we've got are 86%, which is Misty, 42% Tesla, NVIDIA is at 44%, Snoy is at 65%, Palantir, 93%. We got Bitto at 65%, Coney at 53%. So 40% is right in there. All right. It's on the border of, should we trade in this one or not? Oh, this is TSYY. I want to go to hot hood. Let's go see what hood is. 40% is right in there at the boundary. Oh, this is hood. So it went up 448%. If you would have invested in hood last year in October 2024, it went up 448%. That is unbelievable. That is just like, oh my hell, how did that happen? I actually had a bunch of hood, probably $100,000 of it. Not last year, probably mid last year. About 6 months before this, I sold it and put it in something else. It wasn't going anywhere. And so, c'est la vie. Do you know that it's going to do that? No, you don't know. You know, it went up 400%. Okay, well, why don't you go put $100,000 in it today? Is it going to go up 400% next year, or could it flush? You don't know. You don't know, right? And it's too scary to say, well, it went up 400%. It's going to go up 400. I'm going to get that for. What if it goes up 100%? It's still happy, right? Do you think it's going to go up 100% next year? I don't know. Are you going to bet on it? No, not really. Well, then if you feel like this might be a really good stock, but you don't know, there's a better alternative, right? So we're going to go over to the Yield Max Fund, and they're going to take the profits along the way, and you're going to get 67% roughly instead of the 400. Now, if you want to put some into the underlying and anticipate a huge growth, well, that will increase your growth, right? If you have a combination of the two, right? And I'm writing an article for Pitt News Magazine about this. And I want to create, if I can get Grok to do it, or at ChatGPT to create me a calculator, I want to have a calculator that I can have little sliders, and I can say, well, what if I put 25% of, if I have $100,000 and I have 25% in HOO, the underlying HOOD, and I have 75% in HOOY, what would my gain and my yield be? And then you can calculate, do you want more gain? Oh, I want more gain. I anticipate that the market's going to go, okay, put more gain in and have a little lower yield. Oh, I want more yield. I want less gain. I want a little bit more safety, a little bit more security, not quite so gambly. Okay, well, move your little sliders back and forth, and you can have gain versus yield, and it'll tell you what are you happy with? Well, I want 50-50. Okay, well, if you want 50-50, well, then put this much money into HOOD and put this much money in HOOY. So you have a combination of the two to increase your gain. If you think you're going to have a good year on something, well, you might as well be getting more gain. Now you're going to have to sell it, right? You're going to lose your shares, but you're getting more gain. You're increasing your gain and you're reducing your yield. Well, I want more yield. Okay, well, more yield, less gain. See how it works? You can do both. You have a pair of everything. Everything's got a pair. So TSLY and TSLA. TSLA is the gain. TSLY, well, that's the yield. You want more yield? Put more into TSLY. You want more gain? Put more into TSLA. You can have a combination of the two, and you're going to have some sort of gain and yield, and you can just dial it into whatever you want. That's why when people complain about, oh, I'm not going to trade those damn yield max funds, they don't have any gain. Okay, well, get some more gain. Put more gain on. Go buy TSLA. Get some gain. Doesn't mean you don't. It's not one or the other. It's a combination of the two. Now, if you like just lots of yield because it's very safe and comparative, that gain could be big, but it might be negative next year. And then we'd go through that same situation where when the market goes down, everybody loses money, even the yield max funds. But they lose a lot less money than if you had the shares themselves and just go for straight gain. So losing a lot less money is better than losing a whole bunch of money. But the sacrifice of that is that you might not make as much money on the big upsides. So you have to sacrifice a little bit of the upside to get a little bit more security and not quite so big losses when you have losses. Dial it in. What do you want? What do you feel? Okay, so that's how this is going to work. We're going to get big gain or we're going to get big yield. This is HOI. It's got 28% gain. That's pretty damn good. You can't complain about 28% gain. And it also gave you 38% yield for a 67% return. I like this one. Is it going to do it again next year? Is it going to get that 28% gain? I don't know. Because the original was like 400% gain, right? I mean, the underlying stock itself was 400% gain. All right. We've just begun, guys. We took our big break off, and this is what I wanted to show you today. I've got to the end of what I want to show you. There's so much more, though, because we want to go in and show you all of our performance stuff. We want to show you how this converts over to our asset calculators. We got our dream portfolios. We're going to come in and do our group calculations, set our targets, and we're going to work all this stuff out. So now we've got our portfolios all decided. We can come in here and do the rebalance a more smarter way than the way I did it. All right. Rock was saying he's come back and try and see some of the comments you guys made. He says, I read the argument about TSLY versus TSYY, but I like both. TSLY pays me about $30 a month, but TSYY pays me about $20 a week. One of the advantages of TSYY, and the reason we like it, is because it pays weekly. It's a good weekly payer. And so because it pays weekly, you can reinvest, you can compound weekly as opposed to compound monthly. That's one of the reasons we like the yield max funds, because they pay monthly, not quarterly. If you go out to AT&T, they pay quarterly, right? That's what Rock's getting to, is that you're going to get your compounded, your exponential compounded money. So if we go look at AT&T, which is, something we were all excited about, look at how often the dividends come in. It only comes in every quarter. So you get your AT&T dividends, and you only get them every quarter. So you only get to reinvest every quarter. And so your money has to wait 3 months before you can start getting your compounded interest. But if you come into TSLY, you get your money every month. So you get a monthly payment, right? And then if you go to TSYY, so you have to take that into consideration too. You're getting they started out monthly, and then they went to weekly. And when they went to weekly, their NAV stopped decaying quite so badly. But I don't know if the distributions had any effect on that or not. I think it was just that they were starting to get their footing, started to realize where the value of their stuff was. It's so new. They do that every time. Every single one of them flushes out of the gate. But now you can see you get your payments every week, and then you can recompound if you don't need the money. The reason a lot of us are in here is we live off our dividends. That's how we have our income. We like to live off the dividends. But if you don't need those dividends, or if they're paying you more than you need, you can reinvest them and get your exponential growth, right? You get free money on free money. And that's where you really start to grow. That's where your account goes, woo, and you get the hockey stick. So getting free money on free money. And so that's, you get your money every week instead of every month. You can compound more quickly. I think that's, if I'm reading your comment, Rock, that's what your comment you're making. All right, guys. That's about all I run out of time. It's not all I got for you, but it's certainly, we're out of time. So we got a lot more to do. And so tomorrow we're going to come in and we're going to play with day trading. You got to make money somewhere. You either got to go work for it or you can trade for it. If you want to trade for it, you can day trade with me tomorrow afternoon at 1 o'clock. We'll day trade. We'll do a little scalping, a little day trading. It doesn't mean it's the only way to trade. It just happens to be that's, power hour is a lot of fun to trade. So I do that during the summertime. We'll do a little more day trading here in power hour. And so that's what we're doing. And we'll meet you tomorrow at 1 o'clock in the afternoon to do 1 hour of trading, day trading in the power hour. And that's where we try to make a little bit of money so we have money to bring in and invest in these other portfolios. So you can trade for a living, right, by living off your dividends, but you got to put money in. You got to have money to make money. And you got to go out and work for it. You go to McDonald's and work for it, or you can go to the markets and try and day trade for it and get it and, do some position trading. Try and trade to get some money to invest. And that's okay. That's what some of us like to do. Some of you don't want to day trade. That's fine. Go get a job, work at the gas station so you can get money to put it into your dream portfolio, and you can create your dream portfolio. It's going to pay you a UBI, universal basic income. But you got to get money from somewhere. It takes money to make money. And so that's what we're going to try and do tomorrow. We're going to try and do a little day trading and show you some strategies to make money trading so you don't have to go work at McDonald's. You can if you want, though. Or maybe you're a doctor. You like to go fix broken arms. That's fun, too. All right. So however you make your money, then this is where you come put it. All right, guys. That's all I got for you. I'm not going to play around with funny, silly little AI pictures today. I don't think I feel like doing that. Still a little in the morning stage. I don't think we need to be funny and laugh and stuff yet. Not quite there. All right. So we're going to just end it here, and I'm going to let you go, and we will check you out. See you tomorrow. And then Thursday, we're going to come back and we'll pick up where we left off with this one, and we'll start going into our redistribution, and I'll show you where the mistakes went that I made and how I screwed up. I didn't really screw up. I just didn't do it what I think was a more optimal way. And I'm going to show you my more optimal way, the way I think that we should be doing our portfolio rebalancing. And we'll do that on Thursday morning, bright and early, 8 o'clock in the morning. So we'll see you. And then we start classes at the university, 3 weeks, 4 weeks. So looking forward to that. And then we'll pick up this stage here. We'll start teaching here online every single day once we get back to the university. All right, guys, we will see you tomorrow afternoon, 1 o'clock.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.